Hi, everybody. Welcome to the Research Exchange, and I'd like to extend my welcome to the web viewers, and also I'd like to thank Infineon for generously sponsoring the seminar series and supporting the lunch for the audience. And today it's a pleasure to introduce our speaker, Rebecca Lynn. She's a principal in Morgenthaler Ventures. She's an alum here. She got her JD and MBA degree from Haas and Bolt. So she's familiar with Berkeley, part of our family. And she received her bachelor degree in chemical engineering from University of Missouri. And so she also has her technical background. And today she's going to give us an update of a subject that of intense interest to perhaps many of you, particularly those of you who are pondering whether you are joining small startup companies or perhaps starting your own companies or work with big companies when you graduate from here. So Lynn will give us up-to-date snapshot of the market today. Thank you.
Okay. Thank you. Can you all hear me? Is my speaker on? Okay, perfect. So I want to thank you all for coming. It's quite an honor to be sort of on this side of the podium because I was in your all seats for a number of years. Just a little bit on Morgenthaler Ventures, sort of the gratuitous publicity, I guess, that I have to do when I get up here. But so just for perspective on our firm, we've been around for over 40 years. Our founder actually lived through the Great Depression, so he has a lot of insight that he's able to sort of bestow upon us. Currently, we have about $3 billion in assets under management. We were really, really lucky. We raised our 9th fund at $400 million in November of last year, and 99% of that closed before the crash. So we'd like to think we were brilliant, but we were very lucky. We invest 50-50 in IT and life sciences, so we sort of cover a very broad spectrum. And we do both early and later stage investing. And by that, we've done a few seed investments. Typically, we do Series A, but with the economy right now, like a lot of people, we're going a little later stage. We are currently investing. I get that question a lot. And in fact, I just closed my first deal a month ago, and it was a Series B investment in a financial services company called Lending Club. And that was a new investment for us. We came in and led the round, and it was a $12 million Series B round. We have funded quite a few companies out of Berkeley. Gary Morgenthaler actually co-founded 2 companies, Ingress and Illustra, which were very good outcomes for us out of Berkeley. And he currently sits on the board of Crossbow. So we are heavily committed to entrepreneurship here at Berkeley. We just had an event yesterday. It was a coaching session for EECS students here, and we had several partners there to help them, sort of work out their ideas. We do that kind of event quite often, and had a faculty dinner as well. So we are very committed to Berkeley as a whole. So I'm sure you guys have heard a lot of sort of negative things about the economy, and it seems like I've heard venture investing is going away, and I mean those things happen about every 10 years. So. What I'm here today to talk to you about is I firmly believe the best time to start a company is in a downturn. I think there's no better time out there. And there's several reasons for that. I mean, with me, I kind of have to believe this because my husband's starting a company right now. So I definitely am drinking that Kool-Aid, but I firmly believe this. And if I wasn't in venture, I would be starting a company at this point in time. And there are a number of reasons for this. Your opportunity cost is low. Whenever you choose to take a job or work on a project, you've got to think, well, what's my opportunity cost? What am I giving up by doing this? Well, you're not giving up a whole lot right now. Companies aren't hiring, or they've dramatically reduced hiring. You guys have felt this, I'm sure. There's a 45% decrease in available tech jobs from March to March. And the hardest hit is Silicon Valley. Silicon Valley decrease in tech jobs is about 60% right now, year over year, and probably will go up. Companies that are hiring are really focused on cost reduction. And unfortunately, R&D is the first thing to often be cut. So if you're a smart engineer or business person and you want to go work on the next greatest thing at Yahoo, Google, or Microsoft, the chances that that project is tabled or at least dramatically downsized is pretty great. And working in a large company, therefore, might not really be the safe choice that it was a few years ago. Now, I do contrast this. If there's a boom time out there, I think the smartest thing to do, if there's this massive sort of upturn in the economy, is jump on the rocket ship that's going. And I advise a lot of people to do that when Google was happening and when Facebook was sort of this rocket ship going up. But there are not a lot of rocket ships right now, and the rocket ships that were there are in trouble. And so I think your opportunity cost right now in doing your own thing or going to a really interesting startup is pretty low. And the thing to keep in mind, and this is hard. I mean, I've been in your chair. I've been an engineer coming right out of college, and I did do the same thing. I went to Procter & Gamble. But the thing I've realized in sort of the last 10 years or so is that, with the economy like it is right now, if you take a year out and you do your own thing or you join a startup, the same jobs, especially with a Berkeley engineering degree, are going to be there for you in a year that are available right now. And so, the whole, if they ask you what you did in the past year, I started a company or I worked for a startup and I learned some really interesting things is a pretty good answer. It's a lot actually better than I looked for a job, And so you'll be more interesting to the interviewer. And again, I think in the end, you really have to ask yourself, what's right for you. The other thing I'm seeing is access to good talent is unprecedented right now. I've seen entrepreneurs that have, were sort of in the first dot-com bubble come off the bench and say, what, I'm starting a company now because I can hire good engineers and I have access to that talent pool. I've seen many people in this situation that are sort of working around the sort of circles trying to figure out what it is they're going to start. So when we look at the unemployment rate, it's at 8.5% and growing. It's the highest rate in over 25 years. Yahoo, Google, Microsoft, they're all laying people off. Funded startups are folding. They're not hiring. And you're going to see a lot more companies sort of go away in the next 60 to 90 days. So that's happening pretty rapidly. And, it seems like it's very gloomy news, but it's good because those people are people that are on the bench, they've had some experience, and they would like to, work on something right now. And I know a lot of people that have pulled in, engineering resources and things like that because they'd really like to become part of a startup at this point in time. There's also a lot of inexpensive resources, and I talked to a lot of companies in the last couple of days who have been brilliant at how they have leveraged these. With cloud computing out there, it's amazing how much less it costs to get a company off the ground than it did 5 years ago. You don't have to go out and buy servers and hire people to do that kind of work. I mean, it's all there up in the cloud at a very low cost. There's also platforms with APIs that are sort of ready built, which help you with your acquisition cost of customers. So if you can build something off Facebook, you can build something off the iPhone apps, it gets put out there and marketed for you. So you don't have to have this huge marketing budget available to you, that like you did when I did NextCard like 10 years ago. And there's free or sublet office space that is readily attainable. As these companies are sort of downsizing, a lot of them are subletting out, pieces of their office space, or letting people kind of hang out there basically for a period of time. And so those are available. And incubators are a really interesting option right now. I'm seeing incubators sprout up in many places. So here at Berkeley, you've got a couple options. There's the CET incubator, there's the Lester Center incubator, and there's also other incubators outside the university environment, like the Plug and Play Tech Center, which is kind of an incubator. They have sort of a month-to-month fee schedule for startups, which is quite reasonable. So there are a lot of options out there. There's bargain equipment available on Craigslist for companies that are folding, and there's free services available. I mean, free legal work. I know a lot of attorneys that have recently been laid off that are very skilled that are offering services for free now. So incorporation, patent work, all that kind of stuff. An attorney would much rather be involved in an interesting venture than just sort of sit idle at this point in time waiting for the things to sort of pick up. So there is a company, probably the best company that has taken advantage of this. It's unbelievable. I saw them yesterday morning. It's called 12 Seconds. Have you guys heard of them at all? Does anyone know 12 Seconds? So they command about 15% of all Twitter traffic. And they do those 12-second video clips. They've taken no venture money. They're huge. I mean, they're 15% of all Twitter traffic. They've gotten free rent, free legal service. It is unbelievable what they have been able, due to the economic conditions, to sort of wire together and be very successful. And now they're a pretty hot company that a lot of VC firms are after. So in terms of looking at the past, when you look at companies that have been founded in downturns, I'm sure you've heard of every one of these. And a lot of them, it was the same sort of, so when you look at the past downturns through history, you've heard of Microsoft, Whole Foods, Cisco. All were founded in really dire economic times. The other thing to keep in mind for your timing is just sort of looking forward, what's happening, on the horizon. Public companies, when we come out of this, are going to be poised for acquisitions. And the reason is exactly what I just talked about. They aren't really spending on R&D. They can't afford to. So how are they going to compete going forward? They're going to need to get new technology to compete against the incumbents and compete against the startups. And so what people should be asking themselves who are starting a company is, what is it these companies need now? What will they need? And who's willing to pay for it? Are there a couple companies in the pipe that maybe would really find value in what you're doing and would want to acquire you? And I think most people realize this, but it hasn't been in the press as much lately. Public companies have record levels of cash. There's never been a time in history where public companies were sitting on this much cash, $1.7 trillion. So I think we all know that Google, Yahoo, or Google and Microsoft, Apple have a lot of cash. Well, even little Yahoo, who's gotten so beat up in the press lately with the takeover rumors and all of that, they're sitting on $3.5 billion of cash. And actually, I think more than that, if you look at how they're accounting and their options their stock options go. Now, the dark side of the rainbow is all this is true. It's a great time to start a company, but if you do need venture funds or angel money, it's really challenging. And I don't think I can't paint that picture better for you, but I can show you the numbers and the trends, and we can talk through it. However, contrary to popular belief, venture funds are still funding companies, and they're funding new companies. They're not just funding people that they already have in their portfolio. I've talked to a couple people yesterday, and their firms recently funded seed rounds. So even the early stage stuff is getting funded. It is more difficult. I think it's really a lot more difficult with the angel rounds right now because a lot of the angels are private wealthy individuals, and they saw 40% of their net worth get wiped out. That may adjust in the next 6 months again, but a Q4 for angel rounds was really tough. VC firms are being more selective, and they do expect more. But I think a lot of the expectation of more is because it is so much easier than it was 5 years ago to sort of get a proof of concept out there, or just to to prove that people want your product. And the reality is there are some VC firms out there just trying to keep their current companies alive. They don't have a big reserve fund, and they're just trying to support those companies. Our fund is very conservative, almost to a fault, and we're very heavily reserved. So, we're in a pretty good situation, but we're watching things pretty close. But there are other funds out there who haven't done that. When you look at, especially in the clean tech sector, you're seeing a lot of firms sort of in distress trying to support their current companies because they need a lot of money to keep those clean tech companies going. So the net of this is VCs do have money, but a lot of them are just sitting on the sidelines right now, kind of waiting for things to shake out. They're still investing, but they're doing it slower. So I wanted to take a few minutes and to share with you some just overall trends and numbers so you have a good basis for what the past looks like and what Q4 looks like. I tried to get the Q1 numbers, but they're actually coming out. They're being reported today and then published here at the end of the week. So I tried. But even though 2008 was a rough year, especially Q4 of 2008, there were still 1,171 new fundings last year. And that is fundings that happened for the first time, not companies that were getting subsequent rounds, but brand new fundings, which is very good. And this is just sort of showing that, we had this massive bubble in 2000 that everyone was, sort of is aware of, I think. And then it fell off, but we're still in 2008, we're well above historical norms in terms of the amount of venture money going into investments. The interesting thing is the clean tech has risen very dramatically, and I'll show you that here in a minute. And then when you ask about, well, what happened in Q4 of last year? Q4 was down, I think, 29% from Q3, and Q3 was a pretty good quarter, but it wasn't zero. I mean, a lot of the press that you read, you would think that it, just sort of dropped all the way off to zero, but it did not. And so, it did take a hit, and Q1 is going to be a drop down from Q4, definitely. But it, again, is still pretty much in the range of what we would consider normal. So I guess the question is, if you're an entrepreneur right now and you do want to get funded, what is it that you need to do? And there are a few things. And I think these are pretty common sense types of things, and they're pretty much, across the whole venture industry what people would say to you. You need to be really capital efficient. And again, with the resources available right now, that's a little bit easier to do. You also need to show that you can generate revenue quickly. So the best possible situation is you have a product or a service, you prove that people can pay for it, but what you need the venture capital for is to really ramp that, or to maybe add more features and functionality and sales and things like that. These eyeball revenue models haven't worked for a while, and they won't work now. It's good if you can have some kind of proof of concept and really show that customers want the product. It doesn't mean you have to have a lot of sales, but it does mean you have to go talk to your customers and show us that you've gained that knowledge to show that this is something that customers need, want, and will pay for. And have a good, relevant team. Make sure that when you're working on this that you've got the right sort of pieces around you in your team. And always think about the exit. Never start a company without knowing where the exit path is or where a couple exit paths are. And think about it. Who's going to buy me and why? In terms of what we look for in investments, this hasn't changed. This has been the same for years and years and years. It's always a truly disruptive technology or business model, addressing a big market, a platform play that can span across a number of applications and not a single application, a strong founding team, and exit potential. And those things have not changed at all. In terms of what sectors venture capitalists are investing in, the most visible change here is the amazing increase in the clean tech investing in the last few years. I do believe we're in a huge clean tech bubble right now, and there are going to be a lot of bodies around when it explodes. There will be some people who make a lot of money, but there's going to be a lot of casualties in the process. And a lot of these firms that have raised these huge clean tech funds are trying to raise what we call sidecar funds because they're not reserved for them. And they're trying to go to Congress to get money to support their clean tech investments going forward because there's not enough venture money out there to do it. They're truly capital-intensive sort of government projects. But software and healthcare have remained very constant through the years, and that's not going away. The other thing you want to know, and I spoke to a couple people about this, is you want to know how healthy the VC firm is you're talking to. So right now, VC firms are taking a lot of meetings, which is good. But as an entrepreneur, you're busy, and you don't want to waste your time talking to firms who may not be in the market or who may not be investing right now. And so what you want to do, and it's a completely fair question, is ask, if the VC firm has raised a fund in the last 18 months. If they haven't raised a fund in the last 18 months, they're going to have problems, I would say, unless very few firms are going to be able to pull this out, I think. Because what happens is the average lifespan of a firm is about 3 years. You can kind of stretch it to 4, or a fund. So firms have to raise funds sort of every 3 to 4 years. And firms raising funds now are having a very hard time. And so this is just a short list. This is not everybody. But as you can tell, the nice thing here is there's a lot of funds that have raised last year and even in 2007 in the last 18 months that are going to make it out of this fine. And so, you hear this, venture capital is dead and all of that, but there's a number of funds, and a lot of these are sort of the name brand firms you've heard of, quite a bit in the past. They're going to make it out of this completely fine, and they're weathering the storm like everybody else right now. In terms of valuations, if you get funding, the question here is, what's happening on valuations? Well, valuations are settling back. We had sort of very frothy valuations in 2007, really high, and they're settling back to what they were before, essentially. They've come down on average because of the frothy valuations. The venture capitalists have really, overall, have discounted their current portfolios by about 20%. So a little bit, less, I think, than what the market has done. But, in terms of, it's very hard to do mark-to-market accounting on venture capital investments because they're illiquid assets. So people have rapidly, decreased the valuations on those. And you should, as an entrepreneur, expect lower valuations than you would have a year ago. So 3 to 5 million pre on a Series A is pretty much market right now. And in terms of follow-on rounds, the saying is like flat is the new up. If you can get a flat round based on the valuation you got, sort of a year ago in the frothy market, that's pretty good. You do want to be cautious. We have started to see venture capital firms stack on some pretty aggressive preferences. It's not as bad as after the dot-com crash in the early 2000s, but you want to be really careful. I mean, we as a firm don't do that. We try to keep things really clean, but we're starting to see it. And there may be situations where you might get a term sheet from a firm and it's really egregious and it may be in your best interest just to walk away from it. Something important, and I think people are surprised when I say this, and I coach so many people along this path when I talk to them, a lot of very good friends of mine, in fact, is at some point, you really need to ask yourself, do you really want venture funding? Like, if it came your way, do you want it? He's laughing.
You have 6 ways to start. The first 5 are doing grow as you go, piggyback, do everything but take outside money.
Yep.
Get to the 6th one and say, look at the first 5 very carefully.
Yep.
Sometimes you do need to get venture.
Sometimes you do. But I talk to so many companies that sort of, they come to our door and I'm like, God, you got a great business here. You're making money. You're like, this is definitely a money maker. Why are you talking to us? Like, go do more of this and, and you're doing a good job. There are definitely other options out there. And I can't say this enough. Lifestyle businesses are good businesses. If somebody says this is a great lifestyle business, it doesn't mean you're doing nothing. It means I know so many people who are running businesses and making a couple $100 to $20 million a year. And, they're not going to ever be billion-dollar businesses, but who cares? That's a pretty good cash flow if you can get it. And, few businesses truly need venture money. Very few. And so really ask yourself, like, what could I do? How could I grow this? Could I go slower? Could I get some revenue in the door? Like, be scrappy. And just an example, I don't want to turn everyone into iPhone app developers at all, but app developer, you can make good money. And before the app developers, there were affiliates. When I worked at NextCard, I ran their online marketing for them. I regularly wrote affiliates $500,000 checks a month. And these are people running the business sort of out of their living room. And one of them was a 13-year-old kid that I had to ask to talk to his mother, when I would call him. And so I can't say it enough. Like, the internet with the iPhone, with the Facebook apps, with affiliate marketing and running retail sites online, there are so many ways that you can make this equation work. And even offline businesses, there's a ton of stuff that you can do. So ask yourself 6 times, I guess, if you really want venture money. And if you do take venture money, there's some things you have to realize. And again, I have this very open talk with everyone that comes in. If I write you a check for $3 to $5 million, and the next day Google comes to you and says, you know what, we want to buy that company for $10 to $20 million from you, and there's like 2 of you, right? The answer is no. And you would have been, that would be an amazing outcome for the 2 of you. But with venture economics, that doesn't work for us because it needs to be, a 3 to 5x sort of on average. But we have to believe we're swinging for the 10x on the investment. And you also have to realize that you're on a path to sale of the company in 5 to 7 years, and you may lose control of the company. That doesn't mean you're going to be kicked out of the company and somebody's going to destroy it. But there may be a time, because it's not just the VC you're bringing on. When you're choosing this path, you're bringing on a board. And there'll be outside directors, there'll be venture capital people on the board, there'll be a board that votes on some of the major issues facing your company. And that's, that's a reality when you become a company that takes outside money. So there are reasons to take venture capital money. So I don't want to put myself out of a job here. So you do want to take VC money if you really want to swing for the fences. If you've proven a model and you're like, you know what, I'm going to triple down. I want to be a billion-dollar company, and I want to be the biggest, best out there, and I need capital to do that. That's great. There are other companies, too. If you need a lot of capital to start, especially if you have, let's say, a chip company or you have some technology company that you want to, like, sort of realize the business applications of, you're going to need VC money, I would say. And then also if you have to scale very, very quickly. I mean, I'm sure there are other issues, too, where VC money would fit, but those are sort of the main 3 buckets that I can think of that you would need venture money. The other thing to sort of realize right now, and I think it's really smart to keep sort of a macroeconomic viewpoint when you're doing a company and taking venture money, is that realize the liquidity window is closed right now. It's absolutely closed. 2008 was the worst IPO market since 1977. There were only 6 venture-backed IPOs the entire year. We were very fortunate to have the biggest one that went public last year. It was IPC Hospitalis, which was a hospital services company. And the average time to an IPO is longer than it's ever been before. It's 8.3 years. You know, I have, with the legal background and stuff, I did a lot of the sort of corporate law work. And until something fundamentally changes with the structural issues in the IPO market post-SOX, I don't think the IPO market's going to be like it was before for a very long time. You have to be sort of twice the size that you used to have to be in order to go public. And you know, there's all kinds of issues around lack of coverage by research analysts, lack of liquidity, and the IPO market is really not going to come back in a big way, I don't think, anytime soon, unless something changes. That said, there are a lot of companies sort of in the pipe that would like to go public. So I think once the first few of those get out the gate, we'll see what happens. And M&As were few and far between last year, and they were really a buyer's market. The lowest number of M&As since '99, and again, it's a record time to M&A at 6.5 years. And those may not seem that long, but when you're looking at a venture capital sort of cycle, like we need to turn an investment in about 5 years. And so when the years start getting out to 8 and 6 and stuff like that, it becomes really hard for us and the model that we have. Just for perspective here, this just shows you through the years how IPOs and M&As have happened. And you'll see that IPOs were almost 0 back here. And you also see how much more of the total that the M&A volume has grabbed. And 2003 is when SOX rolled out. So we have not seen the IPO market recover since SOX. Do you guys know what SOX is? The Sarbanes-Oxley Act, sorry. Sarbanes-Oxley is what happened after Enron and all the there was a lot of regulation that should have happened, but it sort of took it over the top. So, and it's been really detrimental to startups going public. And this is just sort of, again, understanding where we are in the current market. So what this just shows is sort of where the NASDAQ has been, and then the IPO and M&A. The IPOs are the red line and the M&A are the blue. And what we saw post the 2000 crash, it was about 3 years before the market firmed and then began to rise again. Very similar pattern, actually, after the Depression, believe it or not. So it's about a 3-year cycle. There's all this work, and it's kind of an interesting reading if you ever get a chance on the Zug cycle. It's sort of 7 years of feast and 7 years of famine, and they've modeled the stock market for years and years, and it sort of follows that. So, I mean, I think, that's what we're sort of looking at right now is, there's really not a clear indication when markets will return. The stock market will improve first. It's a leading indicator. But we're sort of thinking at least 2010, and M&As will come back before IPOs. And the net of that is, with that in mind, the markets are going to get better. But right now is a good time to hunker down and do that foundational work for a startup to be prepared for when the markets turn up again. So the key takeaways from this are really, I do believe that a downturn is a great time to start a company. Things are sort of darkest before the dawn, and now is a good time to make the investment or to join a company that's doing some really interesting new things. The opportunity costs are low. There's great access to free and inexpensive resources, and there's really good upside when the economy recovers, and it will recover. Venture capital firms are definitely still investing. The bar is higher. And, the Q1 numbers I expect to be expect it to be pretty dismal. But the thing is it's not, those firms still have that same money. They're just waiting to deploy it. So if you're looking for funding in 6 months, it's actually kind of good for you that Q1 was so bad. It just means they have more money, 6 or 9 months from now. And keep in mind always, venture capital is not the only game in town. There are definitely other sources and other ways to get really exciting companies off the ground. And then always realize that your exit, if you do take venture money, or even if you decide to do your own thing, is an acquisition, not an IPO. And position yourself accordingly. There's also, I don't know if you guys know James Hong or not. He's sort of legendary in the business school. Do you know James? No? He did Hot or Not. And this guy never took any venture money. I think he sold it. It was somewhere between $10 and $20 million about 5 years after he started it. And while he had it, he was kicking off probably $2 million a year in cash. And I mean, these things happen, and they've happened here many times. And so even if you're doing your own thing, I mean, really realize that if you ever want to sort of sell it, that it's a sale, it's not an IPO. And then I think the last 2 things I want to leave you with right now are, be scrappy and absolutely use your network. I mean, network with people and ask. I mean, if you don't, figure out who some attorneys are, that may be on the bench right now, and ask them if they'll help you with some free legal work, with the idea that if you do get funding or are successful, maybe you can pay them at that point in time, or give them a little bit of equity or something, or maybe they'll just do it because they kind of think the idea is interesting. I think the single best barometer for me when a company is, how much of a Pied Piper has the CEO been? Like when people hear this idea, or other people kind of wanting to jump on the ship and like help them out, and that's a really good indicator that the idea is solid, and the CEO can do what CEOs do, and that's recruit. So, and then that's all I had. I thought I'd spend some time and take some questions. So is it appropriate to do that now, or? Okay. Yes. Oh, sorry.
So you mentioned that VC is not the only way to get a company started. You also mentioned a lot of free services as well. How do you make money in that time if you don't want to go the VC way? You mentioned to be scrappy.
Yeah.
What are those? What are the details in doing so? In
terms of finding the free services, or in terms of what?
Getting money.
To get money to pay people,
yeah.
Or to
yeah.
pay people?
Yeah.
You really have to not pay people. I mean, seriously. I mean, 12 seconds literally was like they had engineers that weren't working and like, we'll pay you with burritos. We'll feed you lunch every day. Come hang out. There are other really smart engineers here. And if you get a job in the meantime, great. But if not, come help us build this great product. And then when we make money, we'll pay you, and we'll make it up, And so, I think you got to look at, you always have to be realistic and look at what people's other options are right now. And if you can provide them with some really interesting work in a time period where they may be looking for a job, and actually there are people too, my husband's doing this company, and his engineers are people that have full-time jobs, but they're kind of worried about them. And so, well, you think they'd be just working harder at the job, I guess, but yeah, they're definitely spending some time on the startup because they kind of see that as an interesting sort of path for them after that. So you really have to just recruit people and ask and be like, okay, I know I can't pay you right now, but if your idea is really, compelling, and if people are excited about it, you're gonna have to find the right people. And if they think it's great, then you'll get some people to help you out. And if you can't get somebody to help you out, then that may be a very good sign that maybe you should think of something else to do too. So, and we've been through a few iterations of that. So,
well, there seems to be a consensus building that our healthcare system is unsustainable, and there's going to be a big shake-up there. And I think one of the outcomes is going to be that our drug pricing system is going to become more like Canada's in Europe. They're going to be much lower margins on even probably the blockbuster drugs. And I wonder if is our venture capitalists or the startups in general starting to think in those terms, or is that still too far out in the future?
Just in terms of the margins on drug prices?
Yeah, well, there's not going to be the same kind of return from even blockbuster drugs in the future that we've had in the past.
Well, what our firm is very good at is, if you look at the patents and stuff of Pfizer and all the big companies, it's gone through the floor. They just aren't coming up with new R&D. So our firm is very good. Like, we don't really, whatever they have to sell it at, that's kind of their issue. What we do is we fund super early stage ideas. So we'll, like, OncoMed is one of ours. And we said, okay, cancer is the next huge problem out there facing people. And we found the smartest people in the space working on a thesis that we believed in, which cancer is a stem cell disease, and funded them. And then they got a $1.4 billion investment from pharma who's dying for an R&D pipeline. So for us, because our strategy, unlike a lot of venture firms, is to do very, very early stage and then sell pre-stage 2 clinical trial, we're okay. I have my personal sort of philosophies on the medical system, and I think until doctors are held accountable for their results, that we will continue to have major issues in healthcare. But it's sort of the most unregulated, unreported profession there is out there. And until that accountability comes to bear, there won't be a lot of change in costs. So pharma is an issue, but when you look at 17% of GDP and 5% of that are what we pay doctors, it's pretty crazy.
Any other question?
Of IT, of software firms, and I don't know if you I know the firms in your portfolio, but what are the trends or what are the activities that they're doing right now that are successful?
What are people looking for?
Yeah.
So there's a couple areas that are hot, 3 areas that are hot overall. Cloud computing is really popular, and people are doing a lot of just sort of, I think a lot of VCs are trying to figure out where startups would play in that whole cloud computing continuum. You know, is it that these big companies, you know, the Googles and the Amazons and things of the world are going to sort of own the space, and there's going to be small opportunities for venture firms, or are there really large plays there? That's a question, I think, that's outstanding right now. But I think it's a very interesting area. It's getting a ton of attention, and if you've got the right, you know, sort of answer for that, I think that's a really good area to spend time in. Mobile, with the idea that we're sort of back to the timeshare model years and years and years ago, where, you know, where everything will sort of be mobile. You'll sort of have a dumb, you know, interface to some extent, and everything will be kicked into the cloud. And mobile, really, with the iPhone, is the first sort of answer to the mobile issue, and they've the first model that's done things right. But that's just going to continue, and that, you know, people, this sort of untethered environment is what's going to be the wave of the future. That will continue, where everything's mobile, and so we're looking heavily at mobile plays. And again, the problem there is, okay, well, where does a startup play? Is this something that, you know, Apple ends up owning, or is this something that's sort of cross-platform? And so you really, you know, there's sort of the one app play that can be pretty profitable, but that's not really a venture-funded opportunity. And then there are the platform plays. And so the question is how to sort of be a platform play if you want VC money. And then the other thing is gaming, and that whole intersection of mobile and gaming, I think, is interesting. And a lot of applications are coming up with interesting ways to educate people, you know, in more of a gaming-esque kind of context. And I think that's getting a lot of attention as well. And SaaS companies, of course, are still getting attention. And we actually even did a chip company, believe it or not, in Q4. So, you know, everyone's like, oh, semiconductors are dead. Well, we did a semi deal in Q4. That's a really interesting breakthrough technology. We've pretty much steered clear of clean tech. We have a few investments there that were more technology kind of investments. But for the most part, we kind of stayed shy of that a little bit, just believing that the amount of money needed to make a clean tech investment successful was well beyond the means of a VC firm. So,
what about in healthcare or medical devices or biotech? What's hot in that area?
Yeah, interesting. So I'm not as deep in the whole med. I mean, I actually am working. I had a thought luncheon the other day at our firm, where I invited a very senior person at Kaiser and at Blue Cross who were in charge of strategic initiatives, as well as like 3 startup CEOs, a gal from Navigenics on the consumer-driven healthcare, and a couple of consultants. And we had this great brainstorming session about healthcare and what's coming. And, you know, I am looking specifically, I think the only person that's going to solve the healthcare problem is the consumer. and until you make it the consumer's problem, and until the consumers see the data and the numbers on how sort of bad their healthcare truly is. I think consumers are walking around in a bubble thinking I live in the U.S. and it's great, and they don't understand they're paying 6x for half, you know? And so I think when they figure that out, it'll be a different story. So I'm looking at a lot on the consumer-driven healthcare initiatives and getting that information to the consumer in a way that it can be actionable, essentially. And historically, our firm has done a really good job with the healthcare services routes. I think there's a lot of ways on the payment fronts for hospitals and things, anything in that payment stream to help automate that process, I think is somewhat interesting. But hospitals are really fickle institutions to deal with, and they'll trial you, and as my friend at Kaiser says, they often have all the information and make the wrong decision. So you can have the better product, and you may not get picked up. So I think consumer-driven, personalized healthcare is where things are going. Giving people the choice to go to other states, other nations, whatever, I think is probably long-term. And then the personalized healthcare on the genomics side, I think, is going to be huge. But it's tough. Doctors only started taking genomics classes less than 10 years ago. So, when you look at that, it's tough. So, but there's a ton of opportunity. In med device, there is too. We're seeing, I think, a temporary decline in like the aesthetic kind of devices right now, just because of the economy. So that's a tough area at this point in time.
Other areas
That are going up. A really interesting area, but I've seen a ton of companies in it, is this whole elder care issue. And so people being able to stay in their homes on these sort of networked devices. There's a ton of people looking at it. We haven't seen a great deal. We haven't seen the right thing. And there's this whole question of who's going to pay for it. But when you really look at it and you think about not from the person in the home, but the caregiver's perspective, the daughter or son who's taking care of that older person, and even just the communication stream, I think that's going to be a big driving factor. And if you can figure out a really good solution, I think that's interesting. So, but again, we've seen a lot try, and no one's quite gotten there. So.
I'm just wondering if you see much activity on medical records type of...
Yeah, we stay far away from that. There are 300 medical records companies out there, and none of them are good. And so I don't know if you all have ever seen what EMRs truly are, but they're like the dumbest flat file you've ever seen in your life. Like, you can't even time date stamp and update a field without writing procedure codes on it. And the really scary thing about EMRs, we all think, oh, this is going to solve our problems. Well, you should see what happens when you take the procedure code and you read it in. One of the common examples is you'll go in for an allergy. I'm going to get an allergy shot. Well, it shows anaphylactic reaction. And you can argue, oh, that was an innocent mistake. Or you could say, okay, the doctor got paid 2x for anaphylactic reaction versus, allergy. And so now in my medical record, it shows I have anaphylactic reaction, And so I stay as far away from those as I possibly can. And I honestly believe that what the doctor owns is a sliver of what a patient's medical record is. The patient medical record is how you feel during the day. What are you eating? Where's your energy level? If you're having migraines, when did it happen? What did you eat? Did you sleep beforehand? That's, to me, the patient medical record. And whatever med they prescribed is almost, is sort of part of it, but not like the crux of it. Does that make sense? Yeah, more consumer-driven again. And that's just me. That's not, I'm just speaking for myself, so the other people may disagree with that.
So how can a company approach a VC firm and get the best possible term from them? Is there an optimal time to go after money? Or?
Yeah, well, first of all, when you're going to get into a VC firm, the best possible idea, we get emails all the time just sort of into our general inbox, and I can tell you since I've been there, we've funded none of those. What we do fund and what we do pay attention to is when somebody finds somebody that knows us. And it's not hard. We've been around for 40 years, right? And so you could probably talk to a couple professors, and they're like, oh, yeah, I know so-and-so, and I'll put in a call for you. Well, that's how to do it. Don't ever just cold call a VC firm because, and it's sort of this sort of self-fulfilling prophecy. Part of being an entrepreneur is figuring out what connections you need to make. And it's not that hard to find somebody who can put in a call for you. And maybe it's an old coworker, maybe it's a professor. Your professors all have great connections here. And, just send the email. And if a Berkeley professor sends me an email, I'm going to call him, and I'm going to take that meeting. And I think most VC firms are the same. I mean, you'll absolutely get in the door. So that's the first step. The next one, and this may vary from firm to firm somewhat. We like to see things early. And then if an entrepreneur is new to us, we like to see it early. We like them to say, hey, I just want a cup of coffee. Like, I don't want to come in and give you this big PowerPoint. Can you just have a cup of coffee with me? And we're like, sure. And the entrepreneur comes in, and we talk to them, and we actually try to help. I'm like, well, have you thought of this? Have you seen this deal? What about this? What are you thinking? And we try to make it more of like a thought partner exercise. And then we like to watch you for a couple months, and we like to see what happens, And the people who get funded, and I've actually heard Doug Leone at Sequoia say this, the people who get funded are the people who, we get excited about it, and we're like, well, what about this? And then, the next day it shows up, And we're like, wow, because it's all about execution. And so it depends how early stage you are. But that typically is a good process. Keep it kind of low-key. Go in the first meeting and just have that cup of coffee. And then a couple months later, call them and say, I want to provide an update. I think we're maybe ready to get funding now, and I'd like to hear your thoughts. And go in prepared. And if you have a prototype and you've proven that there's traction in the market, that's when you should really sort of say, hey, this is what we want to do. And it depends too if you're looking for seed or if you're looking for an early A. So seed money is $500,000, let's say, maybe up to $1 million, and an A is $3 to $5 million. And so it really depends, what level you're at. But still, even with seed, having that prototype or some measure of consumer acceptance is really key. So.
I want to ask you about new versus existing companies in your portfolio. So I heard a number that the venture fund is able to maybe keep 1/3 of current company going, maybe 1/2.
Oh, interesting.
From the VC's point of view, keep existing company going versus finding new opportunities. I'm wondering what's your point of view on this?
Yeah, so our firm, like I said, we were very conservative. We actually sort of had this whole reserve study that we had sat down and did. And so there are different funds. So there's Fund 7, there's Fund 8, and then we're investing in Fund 9. So we don't do crossovers. And crossover means I first invest in you in Fund 8, and then I put more money into you in Fund 9. Well, we don't do that. So when we invest in Fund 9, we say, here's what we're putting into the company, and here's what we have reserved. And so in the Fund 7 and 8s, we're fairly well reserved. But, it's actually forced us, we have shut a couple companies down, but it wasn't for lack of funds. It maybe forced the issue, but there were companies that maybe should have been shut down 5 years ago. Maybe never funded, to be honest. And so we've shut a couple down. I think only really 2 that we've just said, you're done. But one of them would have been done even if we had $1 billion in the bank. Actually, both of them, I think, would have been done. There are other funds out there, and I'm especially the clean tech guys. I'm not going to name names. There's one huge clean tech investor out there where they've invested hundreds of millions of dollars in their clean tech fund, and oftentimes they're the only institutional investor, and the other investors that have invested $100 million or whatever are, sitting in Abu Dhabi, or they're in the Russian mafia or whatever, and now they're trying to figure out, how to support these investments going forward, and they're going to the, Obama administration saying, hey, give us a bunch of money in venture, and we'll keep these guys going. And I personally think the further the government stays out of that, the better. And that the last thing venture capital needs is more money. We need to just be smarter about where we spend our funds we have. And so I think getting money from the government, there's never anything for free, And but in terms of shutting companies down, there are a lot of firms that are shutting companies down. Some of it is because, you have to figure out which kids you're keeping and which ones you're shooting, which is really hard. Some of it is that, but there are other ones too where the company looked really great in a good economy, but to keep it going, and it's just it doesn't work anymore. Does that make sense? And so I think you will see more being shut down in the next 30 to 60 days. There are a lot. But again, a lot of those probably shouldn't have gotten funded in the first place. So, any other questions?
Okay, let's thank Rebecca again for the wonderful talk.
Thank you.